Okay, in this chapter, we're going to talk about the monetary system. The key terms are as follows. You might want to take a look in your textbook to review those. If you can pause here and just look at these terms, we'll explain each one of these. The first thing that we think about in an economy is you really have two choices. You can either make an item or you can trade with somebody if they have an item that you want to trade for. We call this the barter system. Now, the barter system works great if someone else has something that you want to trade for, but remember, we're always trading stuff for stuff. There's no money involved in these transactions. It's stuff for stuff. What it means is there has to be a double coincidence of wants. We'll come back to that in a second, but right now the way we think about this is if I have a Big Mac and you have some gas, you have to want the Big Mac and I have to want the gas at the same time. We both have to want to trade with what the other side has in order for barter to actually work. Now, this double coincidence of wants means that both must want what the other has at the very same time. Coincidence means at the same time. So we both have to want what the other has at the same time. Now, money actually makes trade much easier because I can trade Big Macs for reals and I can trade gasoline for reals, and then I can trade those reals back and forth. Being able to have money makes trade much, much easier than having to barter. So money plays a very key role in the development of an economy. What is money? Well, money is a number of different things, but primarily it's something that people use to trade with. Money throughout history has included such things as seashells. In certain economies, people would accept seashells for money. At other times, salt has served as money. People would carry around small bags of salt and they would trade these for items, and these bags of salt became the money in that economy. Actually, during certain times, cigarettes served as money. So the question is, why would you accept a cigarette if you didn't smoke? Well, one of the features of money is that you accept it because someone else will accept it from you. So the reason I would trade you for a cigarette, even though I don't smoke, is that I could use that cigarette to trade with someone else in the next trade. So cigarettes actually formed and represented money in that economy. That occurred in the former Soviet Union as well as during prisoner of war camps. This is a gold coin from the ancient Roman Empire. We begin to see money in the form of metal, and gold being the preferred metal of choice for coinage. Typically it was stamped with some seal attesting to its purity and weight. There are really three functions of money. First of all, it serves as a medium of exchange. It's something we can exchange with one another. A unit of account, and a store of value. Let's look at each one of these a little closer. A medium of exchange is that buyers are willing to give sellers this item and sellers accept it from buyers. We're willing to accept money both as a buyer and a seller. It represents a medium of exchange. A unit of account simply means is it's a way that we can measure the value of things, and we do that through prices. It also allows us to establish a measurement that we can use to deal with debts and loans. The third thing is it represents a store of value. It lets us really trade time for time. As we discussed earlier, it lets us trade present value for future value, or the future value for present value. I can trade today for tomorrow or tomorrow for today. Remember, we can earn money. Once we earn it, we can either save it or spend it. So money allows us to postpone spending and save today and spend at a later time, or to borrow money from someone today and spend it that we then can repay back in the future. So it really allows us to do this kind of time shifting of our consumption and earning and spending. Liquidity is a term that simply means how easy is it to convert something into money. If something's very liquid, it means that someone will trade you money for it very quickly and very easily. If it's illiquid or not liquid, it means that it's very hard to find someone that will trade you money for that item. We tend to prefer things that are liquid. If we say that someone has a lot of liquidity, it means that their assets can be converted to cash pretty quick. All right, a couple of different kinds of money. There's commodity money and fiat money. Commodity money is money that has an intrinsic value or a value in and of itself that it represents value that someone can use that money for, in addition to the three functions that we mentioned. For example, gold has value for jewelry or for other uses. It's also used for coinage, so it's considered a commodity money. The previous example of salt, it also has a use. So anything that has an intrinsic value is considered commodity money. Now, something that is a very important commodity money is gold. Gold has been recognized as a money throughout history because it's been very easy to carry around. It's easy to measure the weight and the purity. It's easy to verify it. And it's very, very hard to copy gold. So I don't have much of a problem with counterfeiting gold. It has been the commodity money of choice really throughout history. If there's an economy that is on the gold standard, what it means is that the central bank of that country will convert the paper money to gold at a fixed rate. Many countries had a gold standard, but today there is no country that actually has a gold standard. Fiat money is simply money that has no intrinsic value at all. It's simply paper that the government has declared to be legal tender or money. Once again, it has no intrinsic value in and of itself. It's just paper that represents the money in that country, and it has been declared to be money by the government authorities. Okay, so the question is, why do people ever accept fiat money if it has no intrinsic value? Well, people trust that someone else will also accept that money. Money really is trust inscribed. When people lose trust in money, money actually loses its value. If people no longer have faith in a country's currency, that currency loses its value. When we think about money, there are coins, there's the currency, and there are also checks. All three of these things represent money in an economy. We also think about cards, credit cards and debit cards or ATM cards. A credit card really allows us to defer a payment into the future. A debit card, on the other hand, allows us to make an instant payment. A debit card is much like a check that you write, and the amount is taken out of your demand deposit account instantly. Like a check, an ATM card is the same thing. Credit and debit cards are not money. They are simply a way that we can make payments. Okay, once again, credit and debit cards are not money. They're just a way that we can make payments. A debit card really is like a check. It takes money out of your account whenever you use it at a merchant, at a store when you buy something, or an ATM machine when you use it to withdraw cash. You're actually taking cash out of your account that exists at the bank that you use the ATM card with. Credit card is a bit different because with a credit card you don't pay for it, those purchases at that moment in time. Credit cards allow you to pay for your purchases at a later date, usually with some kind of a profit or interest that's charged to your account when you use a credit card. All right, now what we want to talk about a little bit is demand deposits. When I go to the bank and open up a checking account, it's also known as a demand deposit. The bank creates an account that I can access my funds in that account by either writing a check or using a debit or ATM card. The money is placed in the bank and it's available to use with a check or debit card. The idea of demand is I can walk back up to the teller and demand my money back, and they have an obligation to give me the money that I've deposited back. This building is the Central Bank of Saudi Arabia, and located not too far from our campus. It's also known as the Saudi Arabia Monetary Agency, or SAMA. There's their website. I encourage you to go look at that website, sama.gov.sa. It is the central bank for Saudi Arabia. A central bank is the bank that oversees the banking system and regulates the supply of money in a country. This is the actual current chairman of the board and governor of SAMA, Dr. Fahad al-Mubarak. He's in charge of basically the printing and the supply of money in Saudi Arabia. If you note, his signature appears on every rial that's issued by the central bank, along with another signature from the Ministry of the Treasury. There are really 6 functions that the central bank provides. It issues the national currency, in this case the Saudi Riyal. It acts as the banker for the government, the Saudi government. It supervises the commercial banks in Saudi. It also manages the kingdom's foreign exchange reserves. It conducts monetary policy for promoting price and exchange rate stability. And it also promotes the growth and ensures the soundness of the financial system. This is a organizational structure. If you stop and look at it, you'll note that there are a number of different departments. There's actually a vice governor and a board of advisors and several other departments, and there are also branches throughout Saudi that represent the SAMA organization. This is something that you can find on their webpage, a lot of helpful information, the GDP annual growth rate, their current inflation rate, the money supply, the reverse repo rate, and the OOR or the ORR. We'll talk about that later, but that data is also displayed for you to refer to. The money supply is simply the quantity of money available in a country. Monetary policy is set by is really about setting the money supply by the central bank policymakers. So when we talk about money, the money supply policy, we're talking about how the central bank manages the supply of money in a country. Okay, now we want to talk about the types of banks in the world. There are really 2 types of banks. There is a 100% reserve bank, and there's also a fractional reserve bank. Under a 100% reserve bank, all the deposits are kept in a safe vault. There are no loans. When I go make a deposit, my money is taken in and put in the vault, and that's where it remains. The reserves represent 100% of the deposits. There are no loans made on the money that I place in that bank. Now, we contrast that to a fractional reserve bank. A fractional reserve bank, on the other hand, only holds a fraction of the deposits as reserves, and it loans out the remainder. And this fraction is determined by the reserve ratio. It's the fraction of deposits that a bank holds as reserves. We also think about how money is created in an economy. It really is created with this fractional reserve banking system. And let's just go through how this actually works. We can start with 1 rial, and we can end up with 10 rials based on the reserve requirement that a bank has. This is kind of like magic, but it's simply a mathematical equation that allows us to see exactly what happens when a bank is allowed to loan out a portion of its deposits. And let's see kind of how this happens, and we'll ask the question, how does 1,000 become 10,000? Well, let's start with the first bank, and let's say that I go into the Saab bank and I deposit 1,000 reals, and their reserve requirement is 10%, so they've got to keep 100 reals in reserve, but they can loan out 900 of that deposit. Now, let's say that someone has borrowed the money and they've went out and made a purchase, and the company that they made the purchase from takes the 900 and deposits that in their bank, so the Riyadh bank would then receive a $900 deposit. Now their reserve requirement is also 10%, so they've got to keep 90 reals. They would have 810 remaining to loan out. So if they lent that out and the borrower then purchased an item, and then the person that sold the item then took the money and deposited in their bank, and let's call it the third bank here, the NCB bank, they would deposit the 810. The NCB bank would keep 81 to comply with their reserve requirement, so they'd have 729 left. Now we see how this process would just continue as it would continue with more and more banks going through this process. The total deposit would actually, if we were to add these up, would total 10,000 reals. And that's also known as the money multiplier. In this case, the money multiplier is actually simply just the reciprocal of the reserve ratio. And let's look at how this works. If the reserve ratio is 100%, that would be a 1 if we were to take the decimal fraction of that. The reciprocal would be 1 divided by 1, or 1. We note that money multiplier, we have no new money that's created because all the bank has to keep all of the deposit in reserve. It can't loan anything out. But if we were to drop that reserve ratio to only 50%, our fraction then would be 0.5. The reciprocal of that would be 1 divided by 0.5, or 2. So the multiplier would be 2. For every real that's deposited in the banking system, you would have 2 reals created within the system due to this reserve ratio requirement. If we drop to 25%, the fraction would be 0.25. 1 divided by 0.25 would be 4. And we can see how this would go along. If our reserve ratio was 10%, in other words, if the bank only had to keep 10% in reserves, the fraction would be 0.1. The reciprocal would be 1 divided by 0.1, or 10. So a 1 real deposit in this case would actually produce 10 reals in money that was created. If we were to drop to 5%, it would go to 20. If we drop to 1%, it would actually go to 100. Just take a moment here and pause at this table and look at it. Make sure you understand it. If you don't, ask me a question about it. We'll try to review it. Okay, let's talk about banks for a minute. The bank capital is simply the money that the bank shareholders have put into the bank. If you and I were going to start a bank, we would put in our money to start the bank, and then we would also look for depositors that would deposit money with us. But the bank capital is how much that the original shareholders have put into the bank to start the bank. Leverage is a very important concept in finance. Leverage, it's also known as OPM, or using other people's money. And the way this works is, let's say, for example, I have 10 reals, and I borrow 90 reals from you, and I buy something for 100 reals, and then I resell the item for 150. I then pay back your 90, and I keep the difference, or the 60 reals. I have earned 50 in profit for my 10. So the leverage here would be very, very high. My 10 reals has actually earned me 50 in profit. Now, the leverage ratio is simply, when we think about banks, is the ratio of assets to bank capital. Assets are all of the loans that I've made and the securities that I have, plus my reserve, divided by the bank capital. Remember, the bank capital is what the shareholders have put in to start the bank. So when we look at a typical bank balance sheet and I've set this up in a T balance, you notice the lines there look like a T, have a horizontal line and a vertical line that splits the assets from the liabilities. On the asset side, we have the reserves, or the amount of cash that the bank has to keep in the vault. We also have the loans that the bank has made, as well as some securities, in this case, that the bank has purchased, and these may be government bonds or stocks. So on the asset side, we have 1,000, and then on the liability side, what we look at is the deposits, the debt that we've taken, the capital that was put in, and that's got to also be the total. Notice real quickly here that the totals have to equal each other, so we have 1,000 in assets, we have 1,000 in liabilities and owner equity. So let's begin first of all. The capital, the original amount that the stockholders that started the bank put into the bank was 50. They had 800 in deposits, and they also borrowed another 150. That's where our 1,000 comes from. Now, can you calculate what the leverage ratio is in this case? Okay, let's look at a more simplified version here. And in this case, the assets divided by the capital is the leverage ratio. So the assets would be 1,000, and the capital would be 50. So it'd be 1,000 divided by 50 over 20. Our leverage ratio is 20. Now, with a leverage ratio of 20, the owners have essentially put up $1 and depositors have put up 19. Now, we have to remember that leverage is very, very risky. It's very powerful, but it's also very risky. Now, if a leverage ratio is 20, a 5% increase in an asset value will provide the owners with a 100% return. In other words, if the asset side goes up only 5%, the stockholder equity or the capital side is actually doubled in size. So it can be very powerful if the asset values are increasing due to leverage. Now, on the other hand, if you have a 5% decrease in the asset value, that would equal 100% loss to the owners. So leverage is powerful on the upside. It's also very powerful on the downside. The capital requirement is the rule that the government establishes on the minimum amount of capital a bank must have. Insolvency occurs when the liabilities are more than the assets, or what I owe is more than what I own. The liability side of the equation is larger than the asset side. You essentially end up with a negative owner equity position in this case. Okay, there are 3 tools that a central bank can use to manage the money supply. They use open market operations, the discount rate, and the reserve ratio. The open market operations occur when a bank buys and sells government bonds. And when the central bank buys bonds, they increase the money supply, and when they sell bonds, they decrease the supply. Let's see how this works. So the central bank has got a stack of reals, and the public banks have bonds, government bonds that they hold as part of their asset security side. Now, if the central bank wants to increase the money supply, what they can do is they can buy the bonds from the bank for cash. So the cash moves out of the central bank down to the public banks, and the bonds move back to the central bank. Now banks have more cash to loan, so the money supply has been increased due to this open market activity. Now, what has to happen in order for the central bank to decrease the money supply is that they then sell the bonds for cash. So the bonds go back out of the central bank system, and the cash comes back in from the public banks back to the central bank. So the central bank now has more cash, and the public banks are now set with more bonds on their asset side. Okay, the discount rate is the rate that central banks charge to make loans to member banks. Now, in Saudi, it's called the official repo rate, or the ORR. And then we'll think about this, the official repurchase rate, or we can also refer to that as the discount rate. Today, that rate is 2%. It dropped from 2.5% on January 19th of 2009, and has remained at 2.5% for basically the last 4 years. Here's a history of what that rate's done. You notice here that the rate was increasing from 2005 up to about 2007 as the economy kind of heated up, the global economy heated up. That rate continued to go up. It was plateaued or flatlining there for a couple of years, and then in the third quarter of 2008, it was at 5.5%. It dropped clear down to 2% by January of 2009. In a 3-month period, this rate really just kind of jumped off the cliff there. And this was due to the global financial crisis. Once again, it's remained at that 2% rate for a number of years. Okay, the reserve ratio is another way that the bank can reduce or increase the money supply. Remember how that worked. If the reserve ratio is increased, then it will reduce the money multiplier, and if it's decreased, the reserve ratio is decreased, and the money supply will increase due to an increase in the money multiplier. Now, if we look at that graphically, there's the reserve ratio and there's the money multiplier. If we look at where we start here, 100 down to 50, you notice that the multiplier tends to start really growing rapidly as we increase that, or as we reduce the reserve ratio. In other words, the lower the reserve ratio is, the larger the money multiplier becomes, because once again it's the reciprocal of that reserve ratio. A small reserve ratio would result in a very large money multiplier, and we see this with the graph. Okay, the reserve ratio has not changed very often. You remember it hasn't changed in Saudi in 4 years. What is the current reserve ratio in Saudi Arabia? The current reserve ratio here is 7%. What would that make the money multiplier? Remember, it's 1 divided by the reserve ratio, so 1 divided by the reserve ratio, 1 divided by 7%, or 0.07, is going to be about 14.28. Okay, one last thing we want to talk about is bank deposit insurance. Why would I ever want to put my money in the bank if I worry about the bank collapsing? Or if there's a bank run. A bank run occurs when everybody wants to go to the bank and get their money back at the same time. In this case, the bank faces a problem because they most likely loaned significant portions of that money out. But to check that, the banks can buy insurance. And we know that insurance always entails this moral hazard. And what we note happens in the banking industry is that the temptation from bank officials to use these deposits to make risky loans is increased because of the moral hazard created when they understand that the government will pick up their losses. So the idea that the bank is able to keep the profits but shift the losses onto someone else is what moral hazard is about. Okay, that is chapter 30. Please watch this video again. You can pause and replay, and be ready to ask questions in class. Thank you.